$750 billion. That is what the world's largest tech companies are spending this year alone, just to build the infrastructure behind artificial intelligence. And here is the strange part. Every time analysts predicted a number, the real spending blew past it within months. This is the story of the biggest capital bet in the history of technology, and the question every investor is now asking, is it finally paying off, or is it a bubble waiting to pop? In late 2025, Goldman Sachs analysts sat down to estimate how much the 5 biggest hyperscalers, Amazon, Microsoft, Google, Meta, and Oracle, would spend building AI infrastructure in 2026. Their number was $465 billion. 3 months later, they revised it upward to $527 billion. They were still wrong. By mid-2026, the real figure had climbed to roughly $750 billion, and some forecasts suggest it could cross $1 trillion in 2027. Break it down by company. Amazon alone is projected to spend around $200 billion this year, most of it on data centers. Alphabet is tracking toward $175 to $185 billion. Meta sits between $115 and $135 billion. Microsoft is following a similar path. Combined, these 5 companies alone will spend more this year on AI infrastructure than the entire GDP of most countries. So where does all that money actually go? Not just to chips. It goes to power systems, cooling infrastructure, switchgear, transformers, and even gas turbines. The U.S. Department of Energy already projects data centers could account for up to 12% of American electricity demand by 2028. The grid was not built for this. One of the clearest winners so far is Micron, a company that makes memory chips, not the flashy GPUs everyone talks about. In its most recent quarter, Micron sales jumped 345% year-over-year, reaching $41.5 billion. Adjusted earnings per share spiked more than 1,300%. Taiwan Semiconductor, the company that actually manufactures most of the world's advanced chips, is another quiet winner in this build-out, benefiting no matter which AI company wins the race. This is a pattern worth remembering. In every gold rush, the companies selling the picks and shovels often profit more reliably than the prospectors themselves. But the real question investors care about is simpler. Is any of this spending actually generating revenue, or is it just a very expensive bet on the future? Here the data offers a genuinely surprising answer. In the first quarter of 2026, global AI sales, excluding China, reached $25 billion. That number matters because it exceeded the industry's estimated depreciation costs of $21 billion, tied to all that data center and chip spending. And this was the second quarter in a row that happened. According to research firm Exponential View, this suggests AI revenue is starting to clear the bar needed to justify the infrastructure spend, though the margin over that bar remains thin. Yet Wall Street is not fully convinced. After the most recent round of earnings calls, 3 of the 4 major hyperscalers actually lost market value, despite reporting strong AI growth. Investors are wrestling with a real tension. The revenue is arriving, but the capital commitments are so large that any slowdown in AI adoption could leave companies with billions in underused infrastructure. There is also a shift happening beneath the surface. Data from developer platforms shows users increasingly choosing cheaper, open-weight AI models over the most expensive frontier systems. That shift does not necessarily threaten the infrastructure boom, since more usage still requires more compute. But it does raise questions about which companies capture the profit from all this demand. So what happens next? If AI revenue growth keeps pace with spending, this becomes one of the great infrastructure build-outs in economic history, comparable to railroads or the early internet. If it does not, the companies holding the most debt and the most underused data center capacity will be the ones left exposed when the music stops. Either way, the winners are becoming clearer. Chip makers with diversified demand, power infrastructure suppliers, and companies that can prove AI is generating real revenue, not just consuming capital. The $750 billion question is no longer whether AI is real. It is whether the economics can keep up with the ambition. The next few earnings seasons will tell us who was right. Sources for this video: Goldman Sachs Hyperscaler Capex estimates as reported by Bloomberg NEF and Motley Fool, July 2026. Micron Technology Q3 Fiscal 2026 Earnings Results. Bloomberg and Exponential View report on AI revenue versus depreciation costs, June 2026. U.S. Department of Energy Data Center Electricity Demand Projections. Company Capex guidance from Amazon, Alphabet, and Meta 2026 earnings calls.